Good morning, everybody. This is Jeanette, and we are coming to you live at Trade Thirsty. I'm here from Mobile, Alabama, and I've got a list of great traders that I've lined up for you guys today. Some of our big hitters agreed to come and spend this Saturday morning with us the week before. We all are going to take a little bit of break, a little happy holiday break. Let me know where y'all are coming from this morning. Want to just do a little housekeeping here too, and let you know that we have a full house today. So we have close to 2,500 people registered for today, and that number is climbing every second I look at it. So we max out at 1,000 in here. So if you leave, you may not be able to get back in and get your seat. So if I were you, if you have to step away from the machine for just a second, I'd stay signed in. Minnesota, South Florida, Colombia, Canada, Bogota. Arizona. Oh, early in Arizona. You got out of bed early, didn't you? Well, it's 8 a.m. here in Mobile, Alabama, and we're so thankful to have you all here with us. We've had a great year at Trade Thirsty, and this Toasted Traders lineup today starts with my good friend. This will be him kicking us off, Rob Hoffman, and then we'll have Mr. Price Headley, Todd Gordon, Andrew Keene, Josh Martinez, Larry Gaines, and then our final speaker today will be Mr. John Seville. Today, Rob Hoffman is going to be speaking about his one award-winning trading strategy that you can use right now. So I'm going to go ahead and get this party started. We have 1 hour to our speakers. Each speaker has 1 hour, so I'm going to go ahead and pass the ball to my friend Rob and let him turn his mic on and share his presentation. And here we go. Let's see. You are the organizer.
Here and all of you around the world.
Everybody hear Rob okay? I can hear you.
Okay, wonderful, wonderful, great, good. All right, looks like people can hear me okay, so let me go ahead and grab that screen from you here. Okay. And to just make sure that everybody can see that. I know sometimes it takes a moment for that to fire up. Everybody should see a screen that says one award-winning trading strategy you can use right now, like we did this week. Outstanding. Well, yes. Good morning, good morning, good morning. It's great to see all of you as well, and good afternoon to those of you that are overseas. Thanks to everybody for being here. And again, Jeanette, thank you very much for the nice, warm welcome. It's great to be with you and the entire group that's going to be here with us today. Got some great speakers ahead. So let's get right into it. Hey, well, hello there in Prague. It's great to see you as well. It's wonderful to be with you guys in Prague just a few weeks ago. So, all right, let's kick right off here. First things first, I just want to remind you, gang, we're going to talk about some profits today, but trading involves risk, not just reward. I like to remind everybody about that. So we don't just start thinking that, hey, we're just going to make our millions overnight. We're not going to have ups and downs because that's just not true. A lot of risk involved with trading, not just reward. If you have any questions about that, consult your financial representative or give us a call. We'll tell you a little bit about some of the risks. With that being said, though, thank you. I'm fortunate enough. I just came back from London a week ago, and I was fortunate enough to win the trader competition over there. That makes my 5th international trading competition win and 10th domestic trading competition win after Las Vegas. So a total of 15 domestic and international real money trading competitions. And the techniques we're going to show today are some of the exact same ones I used to win those, as well as we use them actually multiple times this week in our live trading room. So this is something I'm using live in the real time. So it's not theory, it's not PowerPoint material, it's the real stuff, gang. Before I get started with that, though, I just like to remind you guys, I'm just like you. Sometimes people are afraid to come up to me at the trade show. I'll see them stand 10 feet away from me, and like they look like they want to talk to me, but they're not talking to me. So I just kind of wave them over, like, come on over, And just because I've won these trading competitions, whatever else, I'm just like you. I put my socks and my undies on, just like you guys. These were the actual books I went and checked out from the library when I was a teenager. How to Read the Wall Street Journal. This is part of my library collection, and a little bit old. Obviously, I'm missing some of the trophies and everything over the years for the awards, but it's great to see where we've come from. The old days, like How to Read the Wall Street Journal, to where we actually are as a trader. So I like to tell my retail and my institutional clients alike, I didn't have a Rob Hoffman, that would help me through those ups and downs of trading or help me accelerate the process to become a better trader. But what I did have was passion, and many of you here today have lots of passion in your trading, and that's exciting. And I want to go ahead and help you with that passion, turn that passion into something much more meaningful. I was determined, and many of you here today are determined, so I'm looking forward to helping you here. while I had those 2 full-time and 1 part-time jobs in law enforcement, I was raising a son as I was learning to trade as well. I'm very proud of him, United States Marine here in the United States, helping American citizens in time of need. So I'm proud of what he does for us. I got this lovely wife and beautiful daughter, Sarah, and my daughter Mackenzie. I'm so blessed as a father, and just like you, for most of you, I'm a parent, a husband, a father, and so the that as I was learning to trade, I had those trials and tribulations, and now, even now, I have this international business. I travel to speak to some of the top traders in the world, how to improve their trading, and yet I still have this beautiful little 16-month-old, almost 16-month-old daughter at home too, and so I'm pretty excited, gang. So with that being said, the reason why you're here with me this morning, the reason why so many of you out in California got up, yeah, she is beautiful, isn't she? I'm blessed, I tell you. Thank gosh I had a beautiful wife because she helped us make this beautiful baby, because sure isn't because of my looks. And, so anybody that knows Sarah knows it's definitely because of her, not me. But the real reason why you guys got up so early out in California and or spend your Saturday afternoon with us in Europe is because of this. I've been fortunate enough to win these 15 domestic and international trading competition wins. These are real money trading competitions, and I do this not to brag, but to show how relevant my work is, no matter who you put me up against around the world. And it's exciting to say the least. If I won 5 more trading competitions this year alone, 3 domestic and 2 international, and so very exciting, and so I'm looking forward to getting into this with you. This is what those competitions look like, gang, when some of those big international ones, a lot of traders lined up representing their countries around the world and stuff. We're not going to talk much about those, but I've been able to accomplish some pretty exciting things, during some of these trading competitions, both from a profit perspective and just winning these awards, bringing them home, for us here and stuff like that in the United States. So good stuff. So with that being said, the 4 things I'm going to cover today is going to be knowing your proper setup to even consider a trade, identifying precise entry prices for your trades, choosing proper trading instruments and time frames, and simple technicals that will help you master the direction. Now, what I'm going to do here is, because I'm going to be hitting with lots of information here, I'm going to try to get through all the material, then I'll come back and answer some questions for you. So we're going to kind of kick that off in that fashion, okay? But I'll give you time to answer those questions on the back end here. So with all that being said, what is this trade we're going to talk about today? It's a Hoffman inventory retracement bar trade. I show this to traders around the world. I continue to use it, around the world, both in competitions, my live trade room, etc., my personal trading. And so this is a great one for you to master. And so no matter how many times you've watched this presentation, I've actually added new slides for today to this presentation for the first time ever in honor of our friends over at Trade Thirsty and that, shaking it up a little bit. So there's some new slides actually in here as well. So what is this? It's a price action based trend continuation trade. All right, so what does that mean in English? Well, basically, I'm looking for a trend. I'm looking for a short-term pullback within that trend, and then I'm looking to go ahead and go short once we resume the trend back into the downward direction. Okay, so it's a trend in an uptrend. I'm looking for an uptrend here. I'm looking for the market to pull back a little bit and then break back out for a trend resumption to the upside here. When do I use it? It is absolutely most effective in trending markets. It can be even better when tied with strong fundamental analysis. For those of you that are longer-term investors, the problem with investing on fundamentals is you can have a great fundamental story, great numbers, a great performance in that from your stock, but it may take time for Wall Street to discover your same, theory. So you may sit on dead money for weeks, months, or years before everybody else discovers your great story. So if you can go ahead and wait until you get one of these great setups here, combined with your strong fundamentals, you can avoid perhaps a bunch of that time where you're sitting here, take out a whole chunk of that time where you're sitting on dead money, which in the current environment with terrorism and all pre-earnings announcements and everything else, time is extensive risk to be sure. So it can be great with fundamental analysis. So how do we identify these bars? Let's start with that first. And by the way, yes, good morning to all of you that are joining in. Thanks, gang. Great group here today. Looking back over the last 20 periods on the time frame you're looking to trade for signal bars where the open and the close are approximately 45% or more off their high in an uptrend, or they're 45% or more off their low in a downtrend. Basically ask yourself, how much wick is showing here? Is it approximately 45% or more? So here's what we're looking for. In a downtrend, I'm looking where the open and the close are in the top 55% of the bar, so the bottom 45% or more of the bar is wick. Okay, like here, you see the bottom 85, 90% of this bar is wick, which is pretty extreme. But right over here, this is about 50% wick here. This is about 50% wick down here, about 50% wick down here, meaning that the open and the close are on in the top side here. All right. Now, I want to point out this is 4 individual unique examples. This is not part of a 4-bar price pattern, some sort of consolidation breakout pattern or something. These are 4 individual unique examples. That's very important. The reason why I want to show that is because I want you to see whether it's a big red bar, a tight red bar, a big green bar. It doesn't matter. What matters is the open and the close in the top 55% of the bar in a downtrend. So the bottom 45% here is just wick. No open, no close in that bottom 45% or more. Okay. In an uptrend, it's just the opposite. In an uptrend, I'm looking for the top 45% to be just wick in the top 45% or more. That means that the open and the close have to be in the bottom 55% of the overall bar from low to high. The 55% area or lower is where we need the open and the close. So that top 45% must be wick. That's what I'm looking for. Now, I use this strategy on anything 2-minute or higher. Okay, so I don't use this on tick bars. I don't use this on 1-minute bars. I use this on anything 2-minute chart or higher. 2-minute, 3-minute, 4-minute, 5-minute, 10-minute, 15-minute, 13-minute, doesn't matter. You pick your poison. Anything above 2 minutes. And of course, I've used this quite successfully in my nightly video newsletters and such, where we pick our swing trades as well. So we use this on daily and weekly bars as well. All right. So anything 2 minutes or higher. All right. But these are the kind of bars that we're looking for. So where's the entry in this kind of strategy? Well, the entry is going to typically be 1 cent or 1 tick above or below the signal bar. Why 1 tick or 1 cent? Because this has very diverse applications. We use this in futures, stocks, options. And so typically what we do with the option side of it, we find our underlying favorite instrument exhibiting this pattern, and then we we look for a breakout to the upside or breakdown to the downside, and then wrap our favorite option strategy around it. But 1 tick or 1 cent, we use this on equities and futures equally. Okay, so what this means is 1 tick or 1 cent above or below the signal bar. Well, so these are the signal bars. So in a downtrend, we have these bars that are 45% or more off the low. Well, what I'm looking for then is I'm looking for the bar to roll back over here and break down below by 1 tick or 1 cent, depending on whether it's stock or future, down below this area here, and then that's where I'm placing my order to short. Okay, in an uptrend, I'm looking to place the order 1 tick above the high. So what we have is we have an uptrend. Then we have a bar that pulls back 45% or more, and then I'm looking for the market to resume that trend to the upside. basically what I'm looking for here in simplistic terms, and why this is an institutional inventory retracement bar. Because imagine if this were, let's say, Apple. A lot of people look at Apple. Now, I've been dead on with my analysis with Apple about it coming down here, guys, but even when watching my free nightly videos, I've absolutely been dead on with this. But let's just talk about this, since a lot of people like to go ahead and talk about Apple. If this were Apple, and Apple were going up, ask yourself, is it you or me as retail traders that are stopping Apple from going up and driving it back down 45% or more, even on a 2-minute bar? Absolutely not. I can't tell you how many times I've traded 1,000-share blocks of Apple when it was a $500, $600 stock, and never once, even with 1,000-share blocks at $500, $600, never once ever did I ever move the bid or the offer. Okay, and so the reality is that's not a retail or even smaller institutional size trader like myself going ahead and taking that trade. That is heavy money coming in there, stopping the market from going up and actually driving it back down. So what I'm looking for is to see where that one or more institutions has temporarily stopped the market from going up against the predominant trend, but then after their inventory is cleared away, then the market is free to go back on board the original direction that it was starting at. That's the whole premise of this. Now, a couple other things. How do I exit the trades in this situation? I'm a big fan of trailing trades. Big fan. This gives the opportunity to let the trade run, but if it doesn't run, if it stops and reverses, then I'm looking forward to having it, having the trailing stop in there. I'll bet you if I were to ask you right now today, how many of you here have ever had a winning trade and you wanted just a little bit more profit? So your profit target was up here, just a little bit more profit in the trade, and your favorite guru, your favorite, don't dare wait till it's down against you and actually turned into a loss, and yet you had all this profit on the board, but you wanted a little bit more profit, and you don't move your stops, you don't have trailing stops to allow you here turn trades into losses because you missed it. Exactly. The sin of greed. Well said, TJ, and welcome back as always. Great. So you guys know exactly what I'm referring to you here. And so what we want to do is, and I'll tell you again, my biggest loss in my trading career was actually a result of me having a profit on the board of a couple $1,000s, and I wanted another $8,000 on the trade. I'd had this great run of 5,000. $10,000 up to $30,000 type days, and I went in at $2,000 or so on the board, and I wanted another $8,000 to kind of match that, and I let that turn around and roll over against me and become a loss because at the time years ago I wasn't trailing the trades. So now we try to go ahead and have the market move my way, but if it doesn't hit my goal, well, I want to have that trailing stop. So let's show you how I do that right now. All right. So first things first, I identify a target out into space. That could be a Fibonacci number. That can go ahead and be like what I typically use is daily, weekly, or monthly pivot point numbers. It could be a previous high or low in the market, or a major long-term support or resistance level, long-term moving averages and stuff like that. So a lot of times, though, on an intraday basis, I'm using one of the pivots or so. So with that being said, what I do is I identify my target out into space. Then, as we get to about 50% of the overall profit that I expect on the trade, so here's the initial entry, here's the target. As we get to about 50% of the way up to that target, then I want to trail by about 50% of profits earned. Okay. Now, from there, as we get up to about 80% of the overall profit objective, I want to start trailing by about 80% of profits earned. Then, as we get up to price, I want to trail up 90% of that. Why? Because ask yourself a question, gang. What's more likely to happen, honestly, as we've been going up, up, up the ladder here, and then we're about to hit a major resistance? Is it statistically more likely that it's going to go ahead and just keep on going, 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 or is it more likely it's going to stop and reverse? It's absolutely more likely to stop and reverse. In fact, typically only 1 out of 10, 1 out of 12 times, what it'll do, have a little pop up through there, catch a bunch of retail traders who think that it's breaking out, and then roll right back over there. The infamous breakout trade, right? How many of you have ever been caught over the years in a breakout trade where you get in, and no sooner do you get in, it turns right around and goes against you? So what I want to do is avoid that. So as it gets up to price, now I want to move it up to 90%. All right. Then at that point, if it doesn't have that 1 out of 10, 1 out of 12 times where it'll pop up a little bit more, and then on this trail up underneath, then what we'll do is we'll just put it right under price and expect to be taken out, and that's exactly what happened here. Okay. Now, this is a Japanese yen example. Doesn't matter. This could be Apple. What would Apple be? Well, Apple would be like a round number support or resistance level. Any of your favorite stocks. If they're up in the hundreds of dollars levels, these key areas can be round number levels like the $100, $200, $300, $400 level. If it's been like Apple, where it's been trading between $100 and $120 for the last several months, then it can be the 100, 110, and 120 level are key support resistance levels from a round number perspective. And then, like I said, we talked about Fibonacci numbers and pivot points. So that's how we tend to trail these. Now, where does the stop loss? Okay, how about the stop loss here? 1 tick or 1 cent below the low or the high of the signal bar or predetermined loss value. Plus, let me share a little secret with you about this. Okay, so remember, in a downtrend now, what we have is this market's been going to, it opens up, it goes down, pulls back up. Now I'm waiting for that inventory back down here to be eaten away at. Okay, I'm waiting for that inventory to be eaten away at, and then I'm looking to go short 1 tick below the low here. Well, my stop loss, gang, stop loss is officially 1 tick above the high of this bar. 1 tick above the high of this bar. So this is the signal bar, and whether I enter on the very next bar or I enter 5 bars later, whenever it finally breaks back down, all that inventory gets eaten away. I'm looking to go ahead then and use the high of that signal bar as the official stop loss. Now, let me share a dirty little secret with you. The truth of the matter is, because once that inventory is used up, the expectation is this is going to start whooshing back into the board. It's going to rapidly into the direction. It's going to rapidly accelerate into that direction of that trend. Once that temporary inventory, once that one or more institutions that was temporarily holding the market up, their inventory is gone, we expect everybody to pile right back on this and go boom, boom, boom to the downside. And I'm going to show you that. I'm going to show you lots of great examples of that in just a few minutes. So a dirty little secret is it shouldn't even get back above the 50% level of this bar. Okay, if it does, you have a very high probability it's going to go to here. So if you want to put your stops at 50%, there's absolutely nothing wrong with that. Okay, just a little trick for you. So in the opposite is true in an uptrend. In an uptrend, we're looking to go long here, but if it rolls back down below this 50% level, or the 100% level, depending on how much risk you want to incur. But again, if it goes down below the 50, it's probably going to go to the 100. So you could, if you'd like to shorten up your loss here, move it to half of the bar. But the official final stop for this is 1 tick behind the low of this bar. Okay, so that's how we go and look at the stop losses. So a couple key points to remember here. Think about the concept of rocket fuel. If it's moved to large range quickly, the breakout is likely to fail, or at least barely fail. So this is exactly or a 2-minute bar. It's twice the normal range, and then you get this this bar where it's like, instead of being like 45% wick or 50% wick like these other ones over here, it's way up here in the 85, 90 entry trend. So where are we looking to enter this trade? 1 tick below the low, right? So what happens here is now we're 1 tick below the low, and so that means we've gone all the way back up here. And now what we're waiting to do for this particular trade setup is wait for it to come all the way back down here, break down below that low, and then keep on going. That's a big ask. I'll tell you right now, the best thing to go ahead and expect here, the best thing to look for in this case is going to have it push down here, pull back up a little bit, and then come back over again and hit it a second time. Then that breakout's more likely to actually work. But if you've got to go way down here, then it's got to break this area. Then you want it to give you profit. Well, you can bet that's a bar that's probably going to go ahead and give you some grief and pull back and give you some heartburn first. So I'd actually look to take like a second bar there, or not take this particular trade at all. There's way too many great examples of bars like this that are in the, they're just 45, 50, 60, 65, 70% wick. This 80, 85, 90% wick, especially when it's twice the average range of the average of the normal bars you're trading in, the time frame you're trading, it's not worth the headache as you're getting used to this. I would encourage somebody who's first getting used to this strategy, focus on these kind of bars first. Then as you get good with my strategy here, then you can start focusing on trades like this, or as you start growing in your sophistication or your account size starts growing, then look at some of these other ones. All right, so that was something I wanted to have you remember. Very diverse applications. Again, whether you're a day trader, a swing trader, whether you trade stocks, options, futures, this is a fantastic tool. Anything 2-minute time frame or above, 2-minute time frame or above, this is a great platform to use. I use it, like I said, not just in most of the 15 domestic and international trading competitions, but my live trading room. I use this in my private trading. Very diverse applications and time frames. Another thing I'm trying is to reduce the risk of reversion of the mean. As I just showed you, I walked through that whole strategy, trail the trades. Okay, so don't forget that at all. Now, the next thing here is accumulation in. I'm sorry, let's post back. So, trail the trades, great, we talked about that. The trade the direction of the BBT Pro Trader Pack, or a very basic alternative, a 45-degree angled 20-period exponential moving average. Now listen, gang, if your favorite moving average happens to be a 19.26195 moving average, that's simple, or a 21.859234 exponential moving average, those were the secret ones, by the way, it's okay. Just basically, I'm just kidding about the secret thing, just basically approximately a 20-period exponential or simple moving average, somewhere between 19 and 21. So if you're using something in that area, that's fantastic. All right, so let's take a look at what that looks like. So what I'm looking at is, on my screen, each of the time frames that I trade, which on my screens during the day, I have a 2-minute, 5-minute, 15-minute, hourly, and daily. Okay, and so for each of those time frames, I show about 20 bars of data, and that's exactly what you're going to go ahead and see right here. You're going to see 20 bars of data showing. So then I'm looking at the 20-period exponential moving average and asking myself, is it basically in a nice downtrend? Okay, if the answer is yes, then I could be focusing on all these inventory retracement. If the answer is no, and we're basically flat, that's not very good, because I'm going to tell you right now, the flatter you make this trend, so the flatter that it goes, the less this trade strategy is going to work. I had a guy out in California who was using the strategy really well. He's like, Rob, I don't understand. It was working really well, but now it's not working anymore. And so I go back, I'm like, I don't understand. I keep using this thing over and over again. It's working great. And I'm like, let me see your screens. So I look back at his screens, and next thing you know, he was taking trades with his moving averages like this. And I'm like, well, hey, what are you doing there? And he said, oh, well, but I got a lot more trades that way. And I'm like, well, that's great, but what happened to your P&L? And it's like, well, I know, but that's why I'm calling you. It's like, that's why you want to kind of keep with a nice trendy downtrend, okay? So here's what I'm doing. The trade, and then I'm asking myself, do I have attack on the trend there? Okay, so that's something I want to show you there. So now, with all that being said, in general, just to repeat this before we get deeper into this, we're looking for, in a downtrend, we're looking for bars that are 45% or more off their lows, and then we're looking to break back down below those lows and go short. Okay. In an uptrend, we're looking to have an uptrend. We're looking to pull back 45% or more off the highs. Then we're looking for that one or more institutions inventory to go away, and then the market to spike right back on board the original direction that it was going. Now, let's look at some examples of this. This is Apple on a weekly and then a daily basis. So on a weekly basis here, you can see Apple, and we had a nice downtrend in place in the backdrop. Then you can see this bar, it's 45% or more off the low. Notice here that what happened was for the next several weeks, it actually bounced off that area. So one or more institutions not only stopped this market from going down with that 45% off the low bar, but actually started driving it back up. But watch this, gang. Notice what happens when it gets back down a few weeks later, because remember, we're in a downtrend. So this pulls back down. What does it do for 2 more weeks? It stops right at that level that stopped this market from going down. That one or more institutions had so much inventory at this area that not only did it initially drive the market up, but then when it came back down here, it held it for 2 more weeks. Now, notice that as soon as it finally broke down, it whooshed down over $30 the remainder of that week. Okay, so the market gave out. Now, this is a couple points here. That's one reason why you want to trail your trades. Notice that as it pulled down here, it ultimately reversed back up. So you want to trail it because you don't want you don't want a stock to go $30 your way in a week and then you turn around and let that turn into a loss. That would just be criminal. Where's the stop loss in a trade like this? Well, this was the signal bar. So the stop loss is 1 tick above the high of this bar, right? So it breaks down below, and notice it never even got back up to the 50% level of that signal bar. It just rolled over here, and then you're looking to trail the trade. Now, a couple other things. Some people say, well, there's some good trades over here. There's some good trades over here that we could take. Absolutely. In fact, I'm going to show you how to get access to some of those trades at the end of the session here today. But for here, we're talking about this particular setup. And I have several different great strategies that I use in different market conditions. So here's another example of this right over here. So here we still have the downtrend in place. We're 45% or more off the low. And by the way, I'll take those questions, gang, when we go and get to the end of this. We started a little bit later this morning here, and I know I was still given an hour, but I want to get through the initial presentation, and then I'll be happy to help you, okay? Thanks for the questions, though. So as we go ahead and we're breaking down here, do we still have a downtrend in place? Yes. So, and then we have a bar that's 45% off the low. All good. So what happens here is the market is now sitting here where we're breaking down below right here. So here's your entry. Your stop loss is officially 1 tick above the high, or you can use the 50% level like we talked about. Okay, and so what happens is it breaks down here, pops up just a little bit, and then starts to roll over and dies a horrible death and drops, as you can see here, from about $50 over the next few weeks. Okay, and so what we're expecting is we're in a downtrend, we get these entries, and then we're expecting the market to pretty rapidly accelerate back into that original direction as long as we have a trend. Now, so this time frame on a weekly basis happens to be the exact same time frame on a daily basis on this chart. And the reason why I like to still show this chart, even though it's an older chart, is because I walked through this with you guys live in my free nightly videos as this was happening back when it was happening. So it's kind of like, it's not just something I pulled up on a PowerPoint. It was something live that was happening. I was walking through it on a daily basis. So I like to show things where the proof is in the pudding, and that's I still like to show these charts to this day, even with my institutional clients. So as we go ahead and look down, so here we had the bottom of this bar right here. We had a downtrend in place back here, and notice what happened. Here was the 45% off the low, and like I said, the weekly charts were right over here at the same time. You see this 440 area, 440 area. So what happened was we were 45% off the low, and we sat there for 3 more days. For 3 days, we sat there eating away at that inventory, eating away at that inventory, eating away at that inventory. But look what happened, gang. On that 4th day, we finally broke below the low of this bar over here. And what did it do? It dropped here from 430 down to about 390. So it dropped $40 there over the next several trading sessions. Okay. Now this brings to light a really good point. So the market is going ahead and pushing down, and then it has this big spike back up. Well, it's very likely you could have, if you were trailing well, trailing tightly, got stopped out here. So let me ask you a question. You get into this trade, the market pushes down, you get stopped out. Now all of a sudden a new signal comes along. So here's a new signal. See, another signal bar, 45% off the low. So my question to you is, can I still take this trade right here, short, one tick below the low? Or am I done because I got stopped out from the original position here? What do you think? Absolutely. I can take this as long as I still have the trend. As long as I still have that downtrend, I can retake the entries. You got it. And then you just trail them until the profit takes you out with your profit, and then you look for the next one. As long as you have a trend, you can keep taking them over and over and over again. Okay? Absolutely. So like right over here, you notice one that was 45% off the low. But look what happened. It flattened out. I don't care that it did actually break down below here. That's irrelevant. It really flattened out dramatically, didn't it? Okay? So keep that in mind. Unlike right over here, we had the initial setups working great. We had secondary, really awesome trades that I have working great. Everything was working really well across the board on this. So, but over here, you can see it really started to flatten out and actually got above the 20-period exponential moving average. So write that down. If it gets back above the 20-period exponential moving average, I want to stop looking for short side trades. Okay. All right. So real-time decision making. Let's just take a look at this. So this is an example that happened the other day. If you look here, here's one of those inventory retracement bars. Okay. So I draw a line out here in this space where I'm looking to take the entry. But actually, the market goes up here a little bit because this initial accumulation. So now all of a sudden in the process, it makes another even higher accumulation bar. So now I mark that one off, one tick below the low of that bar. All right, so I'm still looking for an entry here. No entry. Now all of a sudden we get a third inventory retracement bar right here. See it, 45% off the low, gang. And then look what happens. It breaks down below the low there at 1144 and immediately spikes down over the next several minutes, 80 ticks. That's $800 a contract over 15 minutes. It spikes down. So a couple of points here. You have your initial entry. So what you're doing is you're marking this off. And what I'll do then is when I see this and it starts going back up, I'll put a sell stop order down there. Okay. But then it actually goes up and makes another sell. Well, I'll actually move my stop loss, my sell stop up to here. Then it goes and makes another one. Well, then I'll move my sell stop up to here. Okay, that's how I do it. Some people that are trying to be more conservative will wait till it gets to the outermost inventory retracement bar. So you can do the way you choose. But me, I'm looking to go ahead and take the most recent inventory retracement bar short. Now you'll notice, what did it do? After it finally broke down through my inventory retracement bar, it whooshed to the downside, okay, to the tune of about $800 a contract. All right, so let's go back over here. So now let's say the market starts to pull back, you get stopped out of this trade with your profits. Okay, now all of a sudden we have another inventory retracement bar right here. Okay, so now I originally want to put my order to short right down here. But wait, we have another inventory retracement bar that locks in right over here. All right, so what I'll do is I'll look to go ahead and take that trade as soon as we break down below that bar. As long as we break down below the low of that bar, then I'm looking to short. Okay, and if you get the fill, depending where you get your fill here, then what happened was one of two scenarios. Either if you got filled low enough here where this bar filled you, you could have gotten stopped out for a stop loss, above the high here or above the 50% level. Now, if you got filled at the 50% level, you lost 6 ticks. If you got filled at the 100% level, you lost 12 ticks. So that means you had up to $800 of opportunity here, up to plus over here, down up to $120, or it was 60 if you did the 50% rule, the little secret I showed you there. But then we go right back in here, and it breaks back down below that bar, right over here, and then subsequently drops, as you can see, over 45 more ticks. Okay, and how did it do that? When it broke down below this bar, it whooshed to the downside over the next 10 minutes. It whooshed to the downside to the tune of another plus $450. So that means your maximum profit opportunity was approximately $800 on this whoosh. Your maximum profit opportunity here was $450 on this whoosh, and your maximum loss was $120 on this one that you got in and stopped you out. So think about the math there, $1,250 of profit opportunity, $120 negative opportunity as far as stop loss. Do those odds look pretty good there again? Does that make sense? And for those of you that watch me, whether it's trading competitions, live trading room, you watch Colorado John, one of my great students that loves this trade, you can see, and that's why he likes to keep his stops. He usually keeps his stops at up to -8. So he'll take his trades up to -8 ticks. So he'll lose up to 8 ticks on a trade. So this is how this works. And so you'll notice that this basically we're looking for, once we finally break down below these inventory retracement bars, we're looking for whooshes. Okay, we're looking for where that one or more institutions that temporarily held the market up. We're looking at, but the market's in a downtrend. We're looking for it to break down, and boom, down she goes. So let's think about this from an institutional perspective. What mistakes are we trying to avoid here? We're trying to avoid sell-side mistakes where, whoops. Where with the sellers, the thing that happens when the market starts going back up, people stop wanting to sell. So the market's going down, they're thinking, well, maybe I should sell, maybe I should sell. In fact, here's a great example. The market's already gone down some. Well, then they're thinking, well, maybe I should sell, and then the market starts to go back up a little bit, and they're like, ooh, good thing I didn't take that short. You know, this market would have caused me to lose money. And then all of a sudden they come back 5-10 minutes later, or 5 or 10 days later, depending on what the time frame they're trading, and then the market's down, want to go that way. Okay, so that's one of the first mistakes happening there. It distracts the seller from wanting to sell when you get that little pop up. It gives buyers false hope who went long up above. So the traders who went ahead and went long up here start to see it come back a little bit, and they're like, yeah, go back up. So they get this false hope. Well, they could have just been taking a smaller stop loss. Instead they keep hoping it's going to go all the way back up their way, only to have it roll over and go much deeper against them. So that's the second mistake. And then finally, it stops out the traders that need the big, fat bars, before they finally shorted. So what happens is, no, they're not short here. No, they're not short here. But finally, by gosh, they get the rest of this big move to the downside. They short, and then it turns around and goes up against them and stops them out. In fact, right here, this move from here up to here was about 25 ticks. The average retail trader stop in the Russell is 12 to 20 ticks. So it went back just enough to stop out retail traders before it went right back down, proving my point there actually. So, that's what's happening on the sell side with mistakes with this. Now here's some competition winning examples. These are actually ones I took over in Paris, France to win the competitions. So here the market started going down. We went ahead and had the bars 45% off the low. Do right afterwards, 2-minute bars. So I'm showing the intraday examples now. Over the next 4 minutes, 6 minutes, this thing whooshed to the downside about 50 ticks, $500 a contract. Right over here, this was a great one because here the order was out. I was able to see it. The market was going down. We had the 45% off the low. Then it pops back up right in falling resistance. Now, I've got a great setup that takes advantage of this, and we'll talk about that at the end of this. So the presentation. But what I'm looking to do with this particular setup that I'm sharing with you now is break down below, look for it to whoosh down below that, it's about 40 ticks. So I profit up another setup here. So I went short here, and then it popped down again. Okay. Here's another example. This was in crude oil at the time, and so crude oil was coming down, had the bar 45% off the low. I went short, and then it whooshed to the downside here. Okay, so now hopefully you can already, as you see this, whether it's a weekly chart like this Apple chart, a daily chart like this Apple chart, you see these are fractal in nature. What you're seeing on the daily chart, you'll often see on the weekly chart at the same time. And then when you get the breaks, it can be very powerful in nature. Let's take a look at a long side example of Apple late last year that I was also sharing with you guys in those free nightly videos. I like to go with things that we actually talked about, so they're out there as a matter of public record. And so here's an uptrend. So in uptrend, what we're looking for is those bars that pull back. So we can see lots of great entries here. Here's the 45% or more pullback. Your entry is one tick above the high. Here's your pullback, entry is one tick above the high. Here's a double pullback, back to back here. Your entry is one tick above the high. Then you have another one. Here's your pullback. The entry is one tick above the high. All right. So let's think about what's happening there on the buy side mistakes, because I'm trying to get you guys to think more like institutional traders. I'm trying to get you to think more like the hunters, not the hunted. So let's talk about the three mistakes there. Distracting the buyers from wanting to buy. So what happens is you're sitting there thinking about going long. The market goes ahead and all of a sudden starts to pull back, and you're like, whoa, I'm not taking that trade. This would have been the top, and all this is going to roll over, and it would be another loss. Well, only to find it go up higher, like I knew I should have taken that trade. Well, so that's the first thing that's happening. Okay. Then the second thing is giving those sellers, there's always a top catcher and bottom catcher going up, and they think it's overvalued. They think it's going to roll back over below 100 in this case, and so they're shorting. Well, then it starts to pull back down a little bit. They're like, yeah, go back down, go back down. But then it makes a new high, and then they're like, no. So the second group of people is getting stuck to them. Then finally, it stops those late buyers who needed the big fat bars to go ahead and take the trade. It's been going up, it's pullbacks can take out these traders before the things that are traders. So I'm trying to get you to completely change your thinking to the opposite side. Here's another great example of using this strategy, combining a couple of my strategies. This video, along with this, we were in a beautiful downtrend in the backdrop. This was an actual trade that I took over in Barcelona, Spain, right after teaching the concept. So we went to go short one tick below the low of that bar. So right here. What did it do afterwards, gang? It whooshed to the downside about $400 a contract over the next 4 minutes. Okay, so in other words, again, once you get that one or more institutions that's temporarily holding the market up and it breaks back down below, the market's free to go back on board that original direction. So in summary, this can be used on multiple instruments, multiple time frames. This is kind of how I have it set up: 2-minute, 5-minute, 15-minute, hourly, daily. So here's different examples of what that can look like on multiple time frames. And then also, don't forget that until these support or resistance levels are broken, they are one big fat area of accumulation or distribution. Remember, what's happening here is these areas are proven areas now where one or more institutions has a bunch of inventory. Not, think about that. It had so much inventory to sell here that not only did it stop this great run to the upside, but it actually started driving it back down. That's how much inventory came in. Well, so look what happened here in this example, gang. It pops right back up, tries to make it through there. Nope, there's so much inventory, gets knocked right back down. Goes back up again. Nope, there's so much inventory in this volume weighted average price area. It comes right back down again. Then it comes right back up here one more time, hits this area, and it still has so much inventory, rolls right back over again. So until that area is broken, I don't want to take the long because it's one big fat area of resistance. So the way I actually use it on this side of the fence is, and you guys have seen me do this in trading competitions, where I'll have a long side position on, and then it will get back up into this area of resistance, and then I'll take my profit. In fact, I did that notably in Las Vegas because what happened was we had a very big area of resistance, and so I went ahead and I went long. As it got back into this area, I went and said, hey, again, we got a big area of resistance here. I'm going to go ahead and exit this trade. Wasn't the most recent Las Vegas competition. It was an earlier one. But the most recent ones I was doing a lot of shorting. But I have used that before very well to define areas of resistance, which is a great place to take profits. So a couple things here. This trading strategy that I just share with you, try to share it in a different light, different ways here, has been very helpful and resulted not just in my daily trading room, not just in the nightly videos, but also, in several of these trading competitions, these real money trading competitions I've won around the world, including the one I won last week in London. So bring it to 15 domestic and international real money trading competitions. That's more real money on-site trading competitions than anybody else in the world. And I've just shown you one of the real strategies that I use there and beyond, proving that this works. But let's bring it all back to where we started today. Do you remember this guy, the guy with the 2 full-time jobs, 1 part-time job, raising that little son of mine, who's now become a wonderful, productive member of our society? Well, when I was that guy in that uniform, I could have never imagined that one day I would be sitting here trading for a living, teaching people all over the world to trade, have won so many trading competitions around the world with real money against my peers. And so I'm really lucky, I'm thankful, I'm blessed to be here right now with this wonderful group. I can't believe how many people are out here this morning, Saturday before the Christmas and the rest of the holidays here, spending time with myself, Todd, and all the other wonderful speakers and the great people from Trade Thirsty. And so I'm really thankful and blessed that you guys are here. And so what I'm going to do is just tell you one more quick way that you guys can get started with learning to trade more of my setups and start using them right now. So what we did was we put together a 3-part, I did this over the course of a year, we put together a 3-part training course, and it's entries, exits, stops. So you remember earlier in the video I kept showing you, I've got this great setup that goes with these right over here. I've got all these different setups. And so what we did is I put together a 3-part video series explaining those entries, exits, stops on the other setups that I didn't get a chance to talk with you about today that I wanted to. So what it's going to include is another conservative trade and an aggressive trade with the specific entries, exits, stops, and profit management technique. You'll find the precise award-winning trading strategies that will fit your personal trading plan and style. Whether you're a day trader, a swing trader, whether you like to be more aggressive and let things run, or you try to get in there and get out very quickly, we got different strategies set up for you there. Again, this is intraday and end of day, and I've proven that repeatedly how well these work. So whether you're a full-time trader that can hang out with me, trading opportunities, or whether you're a part-time swing trader who has to focus more on multi-day, multi-week equity and or options trades, this methodology is very easy to set up for you. It gets you instant access to the 3-part video courses. Like I said, I did that over the course of a year, so it's several hours of information that I shot and added to over the course of a year. I give you the indicator settings, so every one of you has these indicators on your charts. I give you the specific setups or settings for the indicator, so you guys are good to go. You don't have to buy anything proprietary to go ahead and use this. Yeah, some of these are ideas and strategies I don't share with the public, actually, because there's two setups in here, and then I show some variations of those setups. So it's pretty cool. This is to help you be ready for 2016 now and kick this off. Earlier this year we offered this and really helped people on the back end of 2015. Now this is an opportunity for those of you that didn't miss that opportunity before. Don't be left behind. I keep using these strategies, winning these competitions, doing them successfully in my live trading room and everywhere else, and you don't want to miss these because I use use these. No proprietary indicators are required to use it. In fact, I have whole segments of the training dedicated to using just the free tool that you guys have on all your charting. So it's really cool. And this is so you can have advantages over everyone else who's not looking. So in the end, all it is, it's for only $97. You get access to this incredible multi-hour course. For to do is go to becomeabetter.com/win. Become a better trader. Now I'm going to answer some questions and time for you. It's go to becomeabettertrader.com. I'll type that in for you real quick, and then I'm going to take time to answer questions. I know we started at 9:05, so I get a few minutes of question time with you guys, and so I'm going to answer questions for you. I'm just typing this in, becomeabettertrader.com/win. So that'll go ahead and get you guys all set up with more strategies of mine, similar to the ones I showed you today, but gives you other entry opportunities that, so you combine the two. And in fact, I showed you charts where if you take both these setups, you get magnificent, a huge increase, an exponential increase in the number of trading opportunities you get. So it's pretty cool. Is this only for the futures market? And no, it is not only for the futures market. I want to be extraordinarily clear on that, and it is not only for the futures market. It is for equities. I use this for my swing trade alerts. I use this for my swing trading and options program. It is so it is absolutely not just for futures. That is a very common mistake that people make, and I want to make sure that we do not make that mistake anymore. So how did I create these methods? Great question, Frank. So basically what I did back in the 90s, I looked at all my plates where I was losing money. Because remember I showed you those institutional levels earlier, the institutional mistakes. I was that guy who every time, like this year, my equity curve looks like this. I have got a gorgeous equity curve this year. My equity curve is fantastic, okay? But it didn't always used to be fantastic. And so like back in the 90s, what would happen is, I'd watch the market go up, go up, go up. Finally, I'd get that confidence to take the trade. And then all of a sudden, no sooner did I take the trade, it would go down. Or I'd watch the market go down, go down, go down. Finally, I'd have enough confidence to take the trade, and then it'd go up against me. And I'm like, what the deuce? What the heck? And so what I literally did, I went back because it was so consistent. I was so consistently losing, in these areas. I actually went back and built systems and methodologies around it. And then so now I'm on that institutional side of the trade where all the other retail traders, so basically all my work, every single one of my setups is built around where average retail traders lose money. Okay, and so that's the power of it there. So all the psychology, all the execution is all wrapped up in that. So what people find when they first come to me, it's like, hey, that's where I used to take that trade, but you're taking the trade the opposite way. It's like, that's right. That's why I'm about to make money on this trade. You used to lose money here. Yeah, and so it's like it's no mistake that I've won 15 of these domestic and international trading competitions against some of the people considered some of the top traders in the world. In many cases, the ones in these international competitions that are hand-selected to represent their countries, because I really am dialed in to the institutional side of this. I speak to institutions around the world. Many of you know my crazy travel schedule. And so, I know the institutional side, I know the retail side, and so I see it from both sides. And so they're all born out of that, okay? Is there any time limit to the offer? Well, probably this weekend, I'm assuming. They'll get you the video recording out. Then you have to do it probably within shortly thereafter, I suppose there. Edward, you're very, very welcome. Yes, Frederick, yes, you can use it with the currencies. I use it with the currencies that I showed you earlier was in the Japanese yen, if you noticed there, Frederick. So absolutely. And so how do you use this option, with options? Okay, so basically what you can do is, Deb, you can have like a high delta in the money play if you're going to trade this directionally. And so when you get the breakout or the breakdown through the signal bar, let's say a breakdown, all right, what are some of your favorite options plays if you want to short an option? If you're betting that your underlying instrument's going down, what are some of the things you can do? You can buy puts, sell calls, right? There's a host of strategies you can put on. So once the underlying instrument, kind of like I was showing with Apple, breaks down below that key point, you could either use a weekly or a monthly option. You can do it on the daily. I'm just not a daily options trader, truth be told. So I prefer personally weekly and monthlies. And so you can put on your favorite weekly or monthly options, trade accordingly. Okay. William A. says, great presentation, Rob. Congrats on all your success and thanks for sharing your knowledge. William, you're very welcome. And listen, gang, I really am. I'm sharing exactly what I feel you honestly need to know. These are real strategies